everyone. I hope that you will have a great tutorial session that is meant to transfer knowledge and also unpack on the difficult concept of this module, which is the groups. And everything that I will be trying to do is look at all the previous year question papers. I will try to unpack on complex topics, and we'll try to do a question, trying to apply a bit of our knowledge throughout. Today, we are dealing with Learning Unit 5. For those who want to know where we are dealing with Learning Unit 5. Then from Learning Unit 5, we'll be discussing the consolidation. So this is where you combine two entities, which is the subsidiary, and take the subsidiary to the parent financial statement. So it's two separate companies, the subsidiary company, the parent that has acquired shares into the subsidiary company. So it's combining those two together. And then we are creating what is known as a consolidation. So we are doing consolidated financial statements. In other words, we are doing groups financial statements for one group company, and we'll also be recognizing the company that has got the minority interest, which we call a non-controlling interest. So I'm not gonna try to bore you with the jargon and the technicalities. We will try to apply them as we are doing a question. So the question that we'll be focusing on now, it's on page 75 on the top, but on the book itself, it's on page 81. That's where we will try to be applying our knowledge to our best. I just want to quickly share a screen. I will try to work on, and I would really love your confirmation if you are able to see what we are working on. So I've tried, in the interest of time, to do a template that we'll be working on. This is just in the interest of time. And this, again, is something that I think probably we need to start thinking about, since the exams will be written in a non-venue-based venue. So it's something to think about. If we are able to write these exams electronically, there are already students who are not able to write exams, writing it down with their own hands. They've got to use the PC. So this also helps them in understanding the structure, which is important in accounting, that you do not miss it. So what we'll be covering, of course, today is question 3, as I've said. So basically, this learning unit is a consolidation of a partly owned subsidiary after the date of an acquisition. So as you guys know, that there is a parent, which is in this course called an acquirer. They acquire an interest into another company. And in this case, we are saying partly owned. In other words, you are not wholly owning the subsidiary. There is a person that will exist. So if you are purchasing 60% of the shares, the other 40% of the shares will be owned by another person. And that person, before the revision of IFRS 10 and IFRS 3, that person used to be called minority interest. But with the development and the revision of the accounting standards, that company then was called a non-controlling interest. So one of the things that we'll also touch on is what happens now to the transactions that are between the two companies, the parent, the acquirer, and the subsidiary that is forming up of the parent and the non-controlling interest in terms of the profile. So we'll touch on that as well. So what you're supposed to know after going through today, you are supposed to know how to draft consolidated annual financial statements of a group. in accordance with International Financial Reporting Standard. So one, we have to know the annual financial statements. What are our annual financial statements? It is your statement of profit or loss and other comprehensive income, statement of financial position, statement of changes in equity. Those are the three most important things that you are supposed to know. Two is to be able to do pro forma consolidation journal entries. What does this mean? This means you're supposed to know what journal entries you are supposed to compile after the acquisition, after the interest, after the buying of the shares, pro forma, after the creation of a subsidiary, when there is a parent and a minority interest or non-controlling interest, subsidiary interest. What are the journal entries that you should do? So this is one of the things that we will do today. Calculate and measure and disclose the goodwill which arises at acquisition. The question that we are going to do is not going to cover goodwill, but in the last 5 minutes, if I do not forget, when things get heated up, we will try to explain it, even if we just go through a question 2. So then exactly, this is what I love about groups. There's not much jargon. I'm not going to do other examples that are already offered here. We immediately going to go to do our question 3. And all the basics of the notes, I will try to explain throughout our question 3. I just want to check. Please do not forget, since we are not marking a attendance register physically, to capture your student number. Just write your student number on the chat, your initials and your surname, so that we are able to confirm who was also included in this particular class. So let us go to question 3. Here is our question 3. On the study guide on page 81. Right. So the important thing before we go through this, good thing is this is just one page, but I'm sure you already know by now that it's actually so much huge when you are going through to be answering. This is going to be many pages. But let us go through page, the required on page 81. Draft the consolidated statement of profit or loss and other comprehensive income, the consolidated statement of changes in equity of MLTD Group for the year ended 30 June 2008 in compliance with the requirements of IFRS. So one of the things that they do not mention here, which is very important, that you should always know, and I'm just going to try to insert that quickly. And it is show all your calculations. Very important thing, it's never forgotten in accounting, to always show all your calculations. Very important to not miss it. Show all your calculations. So let us now try to read what's happening here. We are told on question 3, the following are bridge statements of MLTD and NLTD for the year ended 30 June 2008. Therefore, we look what first are we provided. We are provided statement of profit or loss and other comprehensive income for the year ended 30 June 2008. Remember, this is what we are required to do. So we've got MLTD column and we've got NLTD column. So we've got 2 companies and we have to do 1 group. So we're going to come back. We've got statement of changes in equity. We've got balance at 1 July 2007 up to 30 June 2008. That is fine. We see what is captured here. Additional information. We are told MLTD acquired interest in NLTD, which means that our MLTD becomes a parent or an acquirer, acquired 70% of interest in LLTD. So NLTD therefore becomes a subsidiary. NLTD becomes a subsidiary. This happened, take note of the date, on the 17th of July, 2002. We are currently busy with 2008. So the acquiring happened 6 years ago. At that date, which date? 2002, 17 July, the retained earnings of NLTD were 10,000. Retained earnings was only 10,000. There was no goodwill at the date of acquisition. Consider that the carrying amount of the assets and liabilities of NLTD to be equal to the fair value, therefore, at the date of the acquisition. So the first important thing that now we have to do, it is to see up until the current year, how much has our retained earnings be for the non-controlling interest for us as the parent. And for us to do that, we have to do an analysis of equity, trying to analyze N. So we have to do an analysis equity for N, so that we are able to know what is it that we have to include into MLTD's group. So I've tried to capture the basic things that we will need. So the basic things that we will need is to know that we are compiling consolidated statement of profit and loss for the year ended 30 June 2008 for MLTD group. And then eventually we have to also do for consolidated statement of changes in equity. Right. So the important thing that first we have to unfortunately do, we have to do what we call an analysis of equity. So for us just to understand and to know where we are. So this becomes the first calculation. This becomes the first calculation that you have to do. So this will be your calculations, and this becomes your first calculation, calculation number 1, which is an analysis of an LTD. Equity. Just have to bear with me. So in our analysis of changes in equity, remember that now we go first from the beginning. At acquisition, what happened at acquisition? We've got our total column, we've got our at column, we've got our since column, and then we've got the non-controlling interest. Right. Only later on, I'm not going to be much focused now on the making of the format. We're just focusing now on the important thing, which is getting things right. So MLTD, if you read the information, MLTD acquired 70% of NLTD, which means that our NCI, which is non-controlling interest, maybe let us write it in non-controlling interest. This non-controlling interest, in other words, is also used to be called minority interest, because they do not have the full interest. Therefore, they regarded to have the minority interest, non-controlling interest. So share capital at acquisition, we look at how much was the share capital. So let us go to what we are given. Balance NLTD had 80,000 interest, 80,000 rent. So which means that our share capital was 80,000. Our share capital was 80,000, and we were told that the retained income, retained earnings of NLTD were 10,000 on 17 July 2019, which means that here we've got our 10,000. So we've got 10,000, and then that makes 90,000. At acquisition, for us to know that how much was attributable to the parent, we have to say 80,000 multiplied by 70,000, 70%, which gives you 56,000. And then for the non-controlling interest is times 30%, which gives you 24,000. Retained earnings, similar way, we apply the percentage of share, which is 70,000 for the parent, and for the non-controlling interest, it's then 30%. So these are the totals that we've had. These are the totals that we've had. At acquisition, retained earnings 10,000, share capital 80,000 makes 90. For the parent, everything share 67,000, 27,000. Because in this question, we have already been told that there is no goodwill. So there is no goodwill, there is no bargain. This is the information that we've already been told. Therefore, we do not have any goodwill. Therefore, the 90,000, the 63,000, and then eventually the 27,000 remain. So we've got 63,000, 90,000, and 27,000. Remember, here we're saying it's a consideration. So in other words, if this amount was not here, where else would you take it? You would take this amount from your balance sheet or statement of financial position. In your statement of financial position on the investment part, you'll be told how much the investment was at cost. And this is the amount that you come and you put here. And then the non-controlling interest will be the 27,000 that you calculate in terms of whether it's a proportionate share or it's the fair value. We'll try and deal that at a later stage. So we have come up to this far, and now we have got to look, since acquisition, which means that before the current year, how have things been? So we go to our statement of changes in equity, because on statement of profit or loss and other comprehensive income, we won't see anything. So we have to look into our statement of changes in equity. We are told that balance at 1 July 2007, retained earnings of NLTD were 54,000. Were 54,000, which means that whatever retained earnings that we had before were 10,000. So which means that we've got 54,000 that we've been given at the beginning, minus 10,000 that we had before elimination, and this actually gives you 54,000 minus 10,000. This actually gives you 44,000. And this 44,000 must be shared amongst the parent and the non-controlling interest. And this is how it goes. At acquisition part is already completed on the date of acquisition, which is the 17th of July 20.2. Any transaction that happens post to that is since acquisition. So this retained earnings is actually a profit that was made up between 2002 and 2008. So this profit is then shared to the parent according to the percentage of ownership, which is 70%, and then it's also shared with the non-controlling interest according to the percentage of sharing, and that gives you 30,800 and 13,200. Current year profit. For this profit now, we have to go and look up. Here we are given the profit on question 3. We are told that at the current year, NLTD made a profit of 35,000. Total profit. So in other words, this means that in the current year, we would need to say total comprehensive income for the year, and then here say profit for the year, and then say other comprehensive income. This is how you put these things. So for other comprehensive income, we do not have anything. We do not have anything. Just need to copy down all my formulas. But for profit of the year, profit for the year, we are told that we've got 35,000. And this 35,000 you have got to share according to the percentage of sharing between the parent and the non-controlling interest. And this 63,000 at acquisition, we have already completed everything about it. Therefore, we can close that one. And then we eventually have got our total, which is total asset and liabilities at fair value, which should make up all your totals. This is this amount, and here we have this amount. Here we have this amount. Okay. Right, there is our totals. Sorry, just bear with me. Yeah, there is our totals. We've got 169, and then we've got 55,300 for the parent, and then we've got 50,700 for the non-controlling interest. So the next step that now we're going to do now is we should be able now to do our profit before tax note, and then we should be able to capture our statement of consolidation and equity. So where are we going to start? We're going to start with our profit before our statement of comprehensive, a statement of profit and loss and other comprehensive income. So we're going to start with profit before tax note. Of profit before tax, we've got 70,000 plus 90,000. So we say in the brackets, remember, you have to show all your calculations, 70,000 plus 90,000. That gives you 160. Tax expense. Tax expense is 32,000 plus 35,000. No changes there. Uh, 32 plus 35,000. And then we've got profit for the year, which is 227,000. Oh, sorry. We have to deduct our income statement. And then we get to our 93,000, which is profit for the year. And then we don't have anything for other comprehensive income. And then we have total comprehensive income, which is going to give us an amount of, 93,000. Right. Then we are coming to this part here that says total income attributable to owners of the parent and non-controlling interest. Remember, this is one of the things that we will have to do when we come here. This is one of the things that we will have to do when we come here. Comprehensive income is to know how much is attributable to the parent and how much is not attributable to the parent. So we almost have done this part here. So non-controlling interest, we have already looked at the profit share and we did it in our analysis of equity, where we said here, where we said our profit for the year is 10,500. So which means that we already have here 10,500. Now for the owner's part, and it makes it easy, we just say 93,000 minus 10,500, and then we immediately have the amount 93,000 minus 10,500. Which is 82,500. All of them together, they give you 93,000, which is your profit. This is just to make sure that they give you that much. So that makes us now to complete the part of consolidated statement of profit or loss and other comprehensive income. And then we move on and we do a statement of changes in equity for the year ended on 30 June 2008. So let us look at this one. Balance at 1 July 2007. So here we've got share capital for NLTD and share capital for NLTD. Now question is, which one now do we put in down on the equity part? Now for us now to be able to do the statement of changes in equity, it's rather important for me that we go and we do what we know as pro forma consolidated journal entries. So we call them pro forma consolidated journal entries, because this is where I want you to understand what happens at acquisition. So we've got journal number 1. So journal number 1, we had share capital at acquisition. Remember, on your statement of changes on the analysis of equity, you had share capital 80,000 that you had, which we are now recognizing, because remember, this is what has been bought at this stage. And as a group, share capital by its nature, it has got a credit balance. If you put it on the debit side, it means you are eliminating it. You are derecognizing what you had before. Retained incomes, earnings, we were told that it was 10,000. We're also eliminating it on the debit side. And then we have got investment in LTD, which we know by now that it is 93,000. We also have a non-controlling interest that we calculated, and we got to 27,000. Here it is. 27,000. Sorry, this is 63,000. And then this is 27,000. So this 90,000 and this 90,000, they cancel each other. And then this transaction is called elimination of LTD owner's equity and acquisition, because this we are doing at acquisition. So channel number 1 is done. Now the second thing that I want you to think of that I must quickly now put in is the date. We are told that this was on the 17th of July 20.2. This was when that journal entry was done. Journal number 2. Journal number 2 now is a journal entry that we have to do. I'm just going to show you. In terms of the analysis of equity, we have done a journal up to here. This is the journal that we have done, which shows you at acquisition. What now we need to do now, it is to calculate, not to calculate, sorry, it is to do a journal entry that shows the profit, how the retained earnings profit, not the current year. Current year it's profit, previous year it's retained earnings. So we have to do journal entry number 2. Journal entry number 2, it is to recognize your retained earnings. But listen, the retained earnings, we no longer recognize for a parent, because a parent is already a subsidiary. Sorry, it's already acquired a subsidiary. So the only person that now we have to account for in terms of the movement is the non-controlling interest. So we've got their retained earnings of 13,200. Remember, this retained earnings is a credit balance. If you put it as a debit, it means that you are debiting profit or loss, and then you are actually, because now this is no longer profit or loss, it is statement of changes in equity. You are now going to credit non-controlling interest. And this non-controlling interest is also 13,200. So this non-controlling interest here, it's the one that is in the statement of changes in equity or in the statement of financial position. And that's what I say, statement of financial position. And this non-controlling interest is on the statement of changes in equity. So what is going to be our journal entry? Our journal entry is going to be, we are recording non-controlling interest, share of retained earnings for the period, which means that it's from the 17th of July 20.2 to just before the year started, which is 20 June 20.7. So this becomes the main reason why we are doing this journal entry. Then we've got journal number 3. Journal number 3 now, going back to the statement of changes in equity, focuses now on the current year. So on the current year, we only have got profit. So we've got non-controlling interest, which is the share of profit. This is coming from the statement of profit or loss and other comprehensive income. So to make it short, let's just say statement of profit and loss and other comprehensive income, and then we are growing non-controlling interest in the statement of financial position. And how much is it? It's 10,500. 10,500. Reason is we're recording NCI share of profit of the year. So that is our reason. We are recording NCI profit share for the year. And already then, these are the 3 important journal entries that we have covered in terms of the analysis of equity. Now let us go back to where we were. Now, if we go back to the balance at 1 July 2007, this 80,000, we have already eliminated here in the journal, because if you are debiting share capital, it means you are eliminating. Eliminating means you are removing, you are derecognizing in accounting terms. So if this 80,000 is derecognized, it means that the share capital that remains is that of a parent, which is 100,000. $100,000 is the one that remains. And then we look at the retained earnings. Retained earnings, you've got 56,000 from the parent. How much do we have in the current year from the subsidiary? We look back again to our statement of changes in equity. Since acquisition, the parent only has 30,800. So, which means that we've got 30,800. So we're going to say, how much was the parent? 56,000 plus 38,000, which gives you in total 30,800. Sorry. 86,800. And then we've got our total. And the total, this total just simply means that we are up until this far only dealing with the equity part, which is the owner's equity part. And this would be the controlling interest part. The controlling interest part, also we have already done this part. So if we're looking here, under balances, they do not tell us anything about this guy, but we already know that for this guy, what we have done is we have 27,500, and then we've got 13,000. Look, 27 at the beginning, and then 13,200. So it's at acquisition 27,000, and the whatever that we have incurred before acquisition. So if we had here a column for NCI, you would note here we've got 27,000, and then here we've got 13,200. This means that at this stage you've got NCI equal to At this stage, you've got NCI equal to 40,200. 40,200, and therefore this becomes our balance, 40,200, and the total equity is the total plus the non-controlling interest, which gives you 227,000. Change in equity for 20.8 just means what has been the changes that are included in equity. So we go look at total comprehensive income, we look at profit for the year, we look at other comprehensive income, and we look at dividends paid, which are ordinary dividends. So total comprehensive income for the year, but profit for the year, which will not affect your share capital, but will affect your retained earnings. So now we must look at how much we have. We already know here it is, current, it's 82,500. We do not have anything for the comprehensive income. And for this guy, we already know we've got 10,500. Where am I taking this? Here it is here. Right. And the totals, I've just put in formulas so that it just goes on. Other comprehensive income, we don't have anything. Dividends paid, do we have anything on dividends paid? Yes. So I've almost taken the statement of changes as it is so that we can just make changes as we come. So the dividends have only been for the parent, MLTD. NLTD did not pay any dividends, so they've only been paid by MLTD. So how much of the dividends that have been paid? It's 5,000, and nothing has been paid by the controlling interest. So then the next thing that we do is the totals. The next thing that we do is the totals, because this would be the balance at the end of the year. So this then takes us to the completion of this question. So for us to start in the beginning, we've completed the statement of profit or loss and other comprehensive income. We've completed it. We've completed the statement of changes in equity. We've spoken about the analysis of equity, and we've also done the pro forma journal entries, which I've also shown you. So we go back and we look at what if we've covered everything from the required. So we have covered the statement of changes in equity. We have covered the statement of profit and loss and other comprehensive income. So that makes us therefore to be done with this question. So second question that I want us now to look at is a question on tutorial letter 102, which is question 3. But before we do that, I just want to check if there's no questions on what we have just done. All right, now we are going to go and do the second question, which we are going to be looking at only question 3. So we won't be able to finish it in the interest of time, but I just want to show you what you have in terms of your 102. It says selected accounting standards and simple group statements, and then it shows you the questions that have been previously put on exams, and they say group statements, financial statements. So in question 3, they are going to give us questions that are covering learning unit 1 up until learning unit 4. So I just want us to quickly cover this question, which is question 3. That's so much. So question 3 is 20 marks, 24 minutes. Just want us to attempt it and see how far we can get. It's Diamond LTD. So I'm not sure if you have this 102, but it's very important that you have it. So if you can just take 1 minute, a few minutes, just to browse through all this question, so that we can quickly start on the question. I'm giving you net 2 minutes just to be able to go through the whole scenario. Then we can quickly tackle it just now. So we'll be starting just now in a minute. Right. I hope you did try to familiarize yourself with Diamond LTD, the group. So in the interest that we do not make time, we'll try to use the same. We'll try to use the same we'll try to use the same things. I just want to open a new book. For us to use. Right. Only thing that I'm going to use here, I'm just going to remove the amounts. We're just going to deal with this one. Yes. Let's see how far we can get. So let's read the scenario quickly. It's Diamond Ltd acquired 60,000 ordinary shares in PEL Ltd on 1 March 2004. On this date, PEL Ltd had retained earnings of 15,000, and the carrying amounts of the assets and liabilities were considered at fair values. The following represent the abridged trial balances of Diamond Ltd and Pearl Ltd at 28 February 2006. So you've got Diamond Ltd, and then you've got Pearl Ltd. You've got debits, which are showing you the expenses and the assets, and then you've got the credits, which are showing you the equity and the liabilities, including the profit before tax. You've got the required. The required is asking you draft the consolidated financial statements of the Diamond Ltd Group at 28 February 2016, according to the requirement of IFRS, International Financial Reporting Standard. Please note, notes to the financial statements are not required and show on calculations. So that is what we are required to do here. It is to do the notes to the financial, to not do the notes to the financial statement. They do not tell us what to do. They just say draft the consolidated financial statement. So this means you have to do profit, statement of profit or loss and other comprehensive income. You have to do statement of financial position, statement of changes in equity, and then you have to do the journals are not necessarily requirements, but that was just to try and help you understand things better. So let us now try to look at this. We're no longer dealing with MLTD. We're dealing now with Diamond. Diamond Ltd Group. We've got to do a statement of profit or loss. The other statement that I've just not included here is statement of financial position. But let's quickly deal with this one. At acquisition, when we are doing an analysis of Pearl Ltd, the guy that we have bought into, and first thing that we have to know is if we acquired 60,000 shares on 1 March 2004, how much shares were there? So we go here under Pearl Ltd. We see here, it shows the number of shares that were there. It's 80,000 shares that were there. So what we have to do now to calculate the share is, this is now Diamond. For us now to calculate the shares, we have to know how many shares we actually acquired. So it's 60,000 divided by 80,000, which gives you in the percentage format 75%. So this means Diamond is 75%. Non-controlling interest, therefore, will be 25%. So at acquisition, it's clear that we had 160,000 share capital. 160,000. So Diamond, 160,000 will be 160,000 multiplied by 75%, which is 120,000. And the non-controlling interest will be multiplied by 25%, which is equal to 40,000. And then, sorry, I'm just not putting it in the right line. And then your retained earnings. Retained earnings, here is retained earnings. I hope everyone can see. But on the information, we are told that on this date, on 1 March 2004, Pearl had retained earnings of 15,000, which means that at acquisition, we had 15,000 retained earnings, which 15,000 multiplied by 75 is 11,250. 15,000 multiplied by 25% is then 3,750. And then we do the totals, sum, then share capital and retained earnings, 175, and then your Diamond Ltd's share at acquisition was 131,250. Non-controlling interest was 43,750,000. And then we move on. We go to see how much was the investment. So the investment in PEL at cost price was, at fair value, cost price was 160,000. So this means this was 160,000. The next thing is that we look at is whether we have anything called non-controlling interest. No. Are they telling us the policy of the non-controlling interest? No, they do not tell us. So one can safely assume that this difference here, it's a difference which is called, this is the purchase difference. It's now called equity, represented by goodwill, and this is for the parent, because we will have nothing for the, because there is no information that we are provided for the non-controlling interest, so we'll have nothing. The 28,750 would be here, and then we've got 160 plus 43,750, which is this amount here coming from, just want to make this bigger for you, which is this amount that is made up of non-controlling interest, which is the consideration, where you are told that the investment cost price was 160,000, and then the non-controlling interest 203,000. Then the next thing that we have is the since acquisition. So let us look. So this was bought in 2004, and this information is for 2006. So there is years in between. So retained earnings are suddenly 34,000. So if the retained earnings are 34,000, so this simply means that before 34,000, we definitely had. So I just have to fix something. So at the beginning of the year, we've got the retained earnings provided there when they say it's 34,000. You deduct what was there at acquisition, and then this gives you 34,000 minus 15,000. This gives you 19,000, and you do a share. Between a parent and a share of NCI. Right. That is at the beginning of the year. In the current year, what do we have? In the current year, I see we've dealt with this. I see revaluation surplus, but it's not for PEL. So we ignore it, we go for PEL. I see profit before tax for PEL, which is 29,000. And I also see dividends paid. I'm not sure if everyone sees this. And I also see taxation. So I see taxation, I see dividends. So what happens is you go under the profit for the year. So profit for the year is 29,000 minus 10,000, which is the tax. So the 10,000 is the tax, is the taxation. So this becomes 29,000 minus 10,000, which is 19,000. Other comprehensive income, we do not have anything, but I see that we've got ordinary dividends of 8,000. Here it is 8,000. 8,000. So here we do a sharing, 75%. At 25%. And similarly for the dividends paid, we also do a share, 8,000 multiplied by 25%, it is 2,000. And then we are able to do our thing. And then we've got all our totals in here. Right. So we've got our statement analysis of equity that we have already made. So now we can now go and try and capture our profit before tax note. Our profit before tax will be 30,700 plus 29,000. Then our income tax expense. Then we'll be able to do that. Let me quickly do this one. It's 3,700 plus 29,000. $80,700 plus 29,000, and then here we've got 10,500 plus 10,000, 10,500 plus 10,000. Which gives you a profit of 39,200. Non-controlling interest, how do we get its total? The non-controlling interest total is going to be the profit part. It's going to be this 4,750, which is shared in the current year. In the current year, it's shared in the current year, this 47,000. It's going to be this 47,050, and then your profit then it's going to be equal to 39,200 minus 47,050. Let's fix this. This is 39,200 minus 47,050. Right. And then when we come to the statement of changes in equity, we're going to look at how much do we have. Statement of changes in equity. Remember, this we're going to eliminate in any case. So we are going to be left with the parent share capital, which is 150,000. And on the retained earnings side, remember, our retained earnings, I saw a valuation surplus there. Shift cells to the right, because now we have to put the valuation surplus that I saw for the parent. Retained earnings Remember, for retained earnings, this is how it goes. We've got retained earnings, 34,000 retained earnings. But now we have got to look at our analysis of equity. So from our analysis of equity, what we're going to be doing for retained earnings is we're going to say 31,500. Which is this 31,500 of a parent. Plus the retained earnings that we have from the previous year, which gives you 45,750. And then we're going to look, I'm only working on the opening balances. Revaluation surplus. We've got revaluation surplus of 21,200 that we have. We just come and we capture it here. And then we've got non-controlling interest. Remember our non-controlling interest? We're going to the statement of changes. It's going to be 43,750 plus 4,750. So it's basically made up of 43 plus 4,750, which gives you 485. Right? And then the next thing that we are looking at that we have, it's the profit before tax. Profit before tax, which goes only to retained income. I've got to look now at profit before tax. There we have it as 34,450. That is for the parent. And then for the non-controlling interest, it's 4,750. Dividends paid here we have, remember this one of 8,000 is eliminated. So the one that we have is the parent one, which is 9,000. So we've got the parent one, which is 9,000. The non-controlling interest, we do have a dividend here, and there's this one of 2,000. So when we are doing journal entries, I will try to show you this. Therefore, this makes us then to be done with the just want to complete this part. We're done now with the statement of changes in equity. We are unfortunately not going to do this because of time, but what I would have loved to show you is but I can show you here as well. It's what happened to the journal entries of this part. So what happened here is we said debit dividends received, because remember we are returning these dividends of 8,000, and then we said credit non-controlling interest, which is in the statement of financial position, and this, remember, now it's going to add on it, and then we said take out dividends paid, credit dividends paid. So this means from a parent perspective, this 6,000 is gone. This 6,000 that is paid to the parent, it's gone. The only thing that you have is this 2,000, this 8,000 is gone. Hence here, you deduct the 2,000 that you have taken from your non-controlling interest, because it is this 2,000 that we had here, so that we get to the 51,250 that balances. So what we have not yet done here, that I just want to see if we can have time to complete, it's the part of the statement of financial position, consolidated statement of financial position. as at 30 June 2008. And really here, things should be going really smoothly. You've got assets, you've got non-controlling assets. We'll see what we have. We've got current assets. We've got total assets. We've got equity and liabilities. We've got equity attributable to owners of the parent. This is easier. We've got share capital. We've got other components of equity. And this would be your evaluation plus. Then we've got retained earnings, and then we've got non-controlling interest, and then we've got total equity. This is the part that is easy that we can quickly do. Everything else falls under here. So equity components, share capital. We already know that we have these are the balances that we'll be working on. Share capital, it's 150,000. Other components is 21,200. Retained earnings, 71,200. Non-controlling interest, we had 51,250. That means that we can easily quickly do that part here and complete it. This is this part. And then total equity would be 2224 plus 51,250, which gives you 293. And then you've got your liabilities, non-current liabilities, and then you've got your current liabilities. So let us quickly try and fill these things. Non-controlling assets. Non-controlling assets, we've got land and buildings, we've got machinery. Anything else I do not see. So this we do not call land and building property, plant and equipment. Please do not fall in the trap of wanting to write them as they are. So it's 31,500 plus 90. 90,000 plus 10,000. It's basically 31,500 plus 90 plus 10,000, which gives you 131,500. We've got goodwill in this calculation. Goodwill of a parent. Statement of analysis. Goodwill 28,750. And then we have our total non-controlling. Sorry, this is not non-controlling, non-current. Non-current assets. Then we've got current assets. Let's look what we have. I see inventories. What is the inventory that we have? N5 plus plus 10,000. Then we look at what else do we have? Trade and other receivable. Trade and other receivable, it's 65,000. That's all that we have, so we don't have to make calculation. Then we've got investment bank. Then we've got bank, called cash, and cash equivalent is not called bank. It's 65,000. 51,500. So we don't have to write how this amount is made up. Equity, then we go to liabilities. So we've dealt with everything here. We've dealt with everything. We've got trade and other payables. And then we've got bank. So if bank is on credit, it means that it's a bank overdraft. I don't see long-term liabilities. So we've got trade and other payables. 125,600. 23,750. 125,600 plus 23,750. That's, then we've got the overdraft, which is 48,250. And then we've got total. We've got total here. And then we've got total assets. So inventory is 500 and 112. Then we've got total liabilities and equity. So the two amounts then balance. Right, and that makes us now to be complete with our question 3. So what I want you to note is how we have started in the beginning. We have started in making the statement of changes in equity, analysis of PEL Ltd, and then we then made the statement of profit or loss and other comprehensive income, statement of changes in equity, analysis of equity, statement of financial position. So we were able to do everything in once. Now what I will do is I will try to check if we've got any questions. And if you've got them with me. If you do not have any questions, I'll also be uploading my notes just now that we have done together. We'll also, you are also welcome to send your questions that you may have on CT and TAT. Then you can also be able to answer your questions from there. I hope I was able to assist you in any manner in understanding this part. Any questions that you may have from yourself?
Students, you must unmute your mics now if you want to ask the question. So you just click on the mic again. Eh? Otherwise, send it to CT in TAT. It seems like there's no questions, so can we end?
All right. If there is no questions,
okay,
I felt like there was going to be a question that was going to be coming. If there is no one who's got a question, thanks a lot. If you've got any queries, please post them on CTN TAT. And thank you for your time as well. And please study this. It's very important that you grasp the principle. Look at the first question and the second question that we did without goodwill, with goodwill. Understand the pro forma journal entries, and then you will be good.
And just a reminder that these sessions are being recorded, so you will be able to go back by Tuesday, and if you're stuck, you can go look at it again. So just to reiterate that you have that privilege now to go and attend your class again on your own speed. Okay, so can we end now?
Yes, we may end.
Okay.
Thanks, everyone.
Thank you, Sukisani. Well done. Okay.
Thank you.
Good. Right. Bye. Bye.